All right, everybody, back with another episode of the Crypto Conversation series with Bryce and Pizza Mind. Today, we're going to be talking about your perfect portfolio allocation. What does a crypto portfolio look like, and what's the ideal allocation? Again, we're not financial advisors. We're just a couple random dudes off the internet, so don't take this as if it was financial advice for you personally, but we're just going to take a look at what we think.
Just a sample portfolio of adjusted risk. So I would say the first thing you need in there is Bitcoin.
Got to have a little bit of Bitcoin.
That's the thing that you know is going to be around. That's what the big institutions are accumulating.
That's why it all started.
It's the next store of value. It's today's store of value, to be honest.
And I would say if anybody recommends you a portfolio that is 100% altcoins, I would be wary of that. I would say 20% of every strong crypto portfolio, at least 20% should be in Bitcoin, because again, Bitcoin birthed the whole thing. It's like owning, the S&P 500. It's like you can't go that wrong, right? Yeah. By owning it. And so if the crypto market's going to go up, it's because Bitcoin, which started the whole industry, is also going up. But you can find lots of opportunity if you have an actively managed portfolio. You can find a lot of opportunity in some of the smaller altcoins. And so that's why I think the larger chunk of your portfolio should be allocated to altcoins. If you're, actively managing, trading them, tracking your cost bases and all that thing, I do think there's a ton of opportunity. And so I would say the main thing to understand is there's a gradient of altcoins. And it all comes back to market cap and liquidity. Mm-hmm. And market cap and liquidity, they're typically very highly correlated. High market cap, high liquidity, typically. Low market cap, low liquidity, typically. So you're going to want to segment your portfolio by liquidity. And you're going to want, so 20% in Bitcoin, which is the most liquid. I would have another, 60%, 60, right? This is going to take us all the way up to 80% of our portfolio now. 60% in big caps. These are highly liquid. You could get in and you could get out with, tens of thousands of dollars with no slippage. I think it's very, very important to have the majority of your portfolio in these big caps. And that's, I'll call it top 100 altcoins. Because I still think that there's enormous potential, 100x, 1000x potential in still the top 100 crypto coins, right? Once you start going to page 2 on CoinMarketCap and 3 and 4, and you're getting into the thousands, right? These crypto coins have very, very small market caps, maybe $1 million or $3 million. So they're going to be very jumpy, very volatile, but they're illiquid. So if you want to buy $10,000 of a very small market cap coin, that $10,000, it might be advertised as, $2.50 per coin. You might slip the books all the way up to $3.50 and get a really bad price. So that's called slippage, and it's a function of illiquidity. So you got 60% in these big caps, strong, fundamentally researched coins, 20% in Bitcoin. That other 20% is what Pizza Mind kind of specializes in, which are those super high risk, super high reward micro cap coins.
The micro caps, or the moonshots, as they're commonly referred to, where you're not really trading, you're gambling. But this is where your life-changing profits can come from. And these are the things that are between $1 and $10 million for a market cap. They might not even have any good exchanges yet. And as you mentioned, it's hard to get into these things because of the liquidity. So you might only be able to put $100 or maybe $1,000 in. And you can't buy $10,000 worth of this stuff at a time. You have to take some time to accumulate this.
Yeah.
But limiting your portfolio to 10% of this stuff that could potentially 100x or even 1000x is awesome. But if it all goes to zero, it's only 10% of your portfolio.
Yeah, 10 or 20.
Yeah, that's not a problem. But I would say I would want to limit it to 10% if possible.
And maybe the other 10% you could put in NFTs or something like that.
I was going to say that the last 10%, I would actually put in stablecoins.
Okay,
I would put
like
in
that.
Stablecoins or some other yield generating type of deal. Maybe it's stuff that's staked. Maybe it's whatever the
an LP token
is. Whatever it is, it's earning you money just for holding it. So then you can then buy more of the other stuff.
Okay, I like that. Yeah. I think stablecoins deserve a piece of everybody's portfolio. I think NFTs are going to be big. But understanding that weighting, I think, is really important between big caps. And again, it has nothing to do with the price of tokens. You have to look at the market capitalization and the liquidity. Okay. Now, how do we find the liquidity? Some people, don't want to go and analyze every order book one by one. So if you go to a website called coingecko.com or coinmarketcap.com, and you click each coin and go down, there's a little tab that says markets. You can click that, and then you show every single trading pair on every single exchange that hosts that coin. So that's great. You could see, there's plus or minus 2% of the spread, $100,000 on each side of the book. Okay, or $1 million or $25. I've seen everything. I've seen no liquidity on the books for some coins. So you really got to be careful there.
Yeah, you do. And the name of this game isn't so much to win big, it's just don't lose.
Yeah, just don't die.
If you don't get wiped out, there is so much growth potential left for this industry that if you're in pretty much anything that's in the top 50 or top 100, it still has a ton of room to grow. We're reshaping the way this entire world economy works and the rails upon which things are built.
Let me add one more thing here before I forget. On that 20%, that 10 to 20% of your portfolio, that's the high risk stuff. It's also very important to get very comfortable with crypto wallets across each ecosystem, because a lot of these newer, smaller coins that have that 1000x kind of potential, they're hard to acquire, right? Because you have to download a certain wallet. You got to go to a certain ecosystem to farm it. And it's not just like you could go on Coinbase and click buy and it's easy. So the folks who are watching, who are more technically inclined and more kind of excited about getting involved in a lot of the different ecosystems, are going to find more of the opportunities because they're going to be plugged in. They're going to be listening. They're going to be in the Discords. They're going to be using the right applications to collect airdrops and all this stuff. So it does take a high degree of activity in order to be successful, I would say.
Yeah, and the last thing that I would mention is, as far as not losing, spin up a new wallet when you're going for some of these high-risk things, or if you're going on a new exchange, or you're getting a new NFT platform or something you've never heard of. There's scams that poses this stuff all the time. So don't have the same wallet that all of your big caps in and all of your wealth is stored in that you're using to trade. Just spin up a new one and see what happens. Move just a little bit of funds in there and always test things out.
And here's what a lot of people don't probably know, is that if you have a hardware wallet like Ledger, you could still use Uniswap or whatever through your Ledger and sign transactions really through MetaMask with Ledger.
Yes.
But people also didn't know that one Ledger device could have hundreds of Ethereum wallets, right? Hundreds of Ethereum addresses. So, or Solana or whatever. And so you don't just have to buy a bunch of new hardware wallets every time you want a new wallet. You could have your one, $99 little hardware wallet, and that one hardware wallet could have dozens and dozens of different addresses, right? They're all going to be derived from the same private key, the same mnemonic or the 24 words that you have, but it will anonymize the public address. So you'll refresh a bunch of new addresses, keep the same one. That's another thing that you should be doing. Like Pizza Mind said, don't keep all of your coins in one address. You should keep them pretty much, in different accounts. That's the way I think about it.
Yeah, so our portfolio looks 20% Bitcoin, 60% altcoins, 10% microcaps, and 10% stuff that's generating a yield.